Force 2. Big Business and Entrepreneurship. The second major force in the industry's transformation was the rise of mutual funds to become big business. The quantum growth in fund industry assets from $2 billion in 1950 to $8 trillion in 2005 has been both cause and effect of the shift in the industry's prime focus from stewardship to salesmanship. For a tiny industry whose birth in 1924 was quickly followed by tough times, the Depression and then World War II, stewardship seemed essential. But in the easy times thereafter, an era of almost unremitting economic prosperity, salesmanship became the winning strategy. The most powerful force behind the change was the emergence of mutual fund management as one of the most profitable businesses in our nation. Entrepreneurs could make big money managing mutual funds. In 1958, the whole dynamic of entrepreneurship in the fund industry began to change, taking an unfortunate direction for mutual fund shareholders. In the industry's early years, funds were run by small, privately held professional firms that could make a tidy profit by managing money, but could not capitalize that profit by selling shares of the company to outside investors. The SEC maintained that the sale of a management company was the sale of a fiduciary office, and that the profits reaped by the manager from the sale represented an illegal appropriation of fund assets. If such sales were allowed, the SEC feared, trafficking in advisory contracts would follow, a gross abuse of the trust of fund shareholders. But a California management company challenged the SEC's position. In the ensuing court battle, the SEC lost. As 1958 ended, the regulatory wall that had prevented public ownership of management companies since the industry began 34 years earlier came tumbling down. A rush of initial public offerings followed, with the shares of a dozen management companies quickly brought to the market. Investors bought the shares of these companies for the same reasons that they bought Microsoft and IBM, and for that matter Enron, because they thought that their earnings would grow and that their stock prices would rise accordingly. Business growth quickly took center stage in the mutual fund industry. Observing this change in 1967, economist and Nobel laureate Paul Samuelson sized it up pungently. There was only one place to make money in the mutual fund business, as there is only one place for a temperate man to be in a saloon, behind the bar and not in front of it. So I invested in a management company. When he realized that public ownership of management companies would not only be a boon for the managers who worked behind the bar, as it were, but be a bane for the fund owners who enjoyed their libations in front of the bar, he was wiser than he could have imagined. Despite being an industry insider, president from 1967 to 1974 of Wellington Management Company, a fund manager that had itself gone public in 1960, I shared Samuelson's insight with considerable concern. In a 1971 speech to my senior associates, I sounded the alarm. All things considered, it is undesirable for professional enterprises to have public stockholders. This constraint is as applicable to money managers as it is to doctors or lawyers or accountants or architects. In their cases, as in ours, it is hard to see what unique contribution public investors bring to the enterprise. They do not add capital. They do not add expertise. They do not contribute to the well-being of our clients. Indeed, it is possible to envision circumstances in which the pressure for earnings and earnings growth engendered by public ownership is antithetical to the responsible operation of a professional organization. And so it has proved to be. This is not to say that I had the gift of perfect foresight. To the contrary, my idea was merely a recognition of the obvious. The fund industry had developed a structure that would favor the interests of managers over the interests of owners, a direct contradiction of the stated purposes expressed in the 1940 Act. Force 3. Fund managers become subsidiaries. The third major force in the industry's transformation, and a rather unrecognized one at that, was the growing control of mutual fund management companies by large financial conglomerates. As the concept of publicly held management companies gained acceptance and as substantial earnings growth materialized, giant banks and insurance companies, eager to take the new opportunity to buy into the lucrative fund business, began to acquire fund managers, often at huge multiples of their book value. These conglomerates also had a voracious appetite for privately held fund management firms. During the past decade alone, at least 40 fund managers have been acquired. Indeed, the ownership of some fund firms actually has been transferred from one owner to another numerous times, producing the very trafficking that properly concerned the SEC a half-century earlier. Currently, among the 50 largest fund managers, only 8 remain privately held, plus mutually owned Vanguard. 41 firms are publicly held, 6 directly by public investors, and 35 by giant financial conglomerates. Of these management company subsidiaries, 22 are owned by U.S. banks and insurance companies, 6 by major brokerage firms, and 7 by foreign financial institutions. When a corporation buys a business, fund manager or not, it expects to earn a hurdle rate on its capital. If the cost of acquiring a fund manager were, say, $1 billion, and the hurdle rate were 12%, the acquirer would require at least $120 million of annual earnings. In a bull market, that may be an easy goal for a fund manager. But when the bear market comes, we can expect its parent organization to undertake actions like these. 1. Maintaining existing management fee rates or even increasing them. 2. Adding new types of fees, such as distribution fees. 3. Slashing management costs, or even 4. Getting its capital back by selling the management company to another owner at a profit if possible. The change in the mutual fund industry from profession to business was clearly accelerated by the shift in control of a major portion of the industry, first from private to public hands, and then from independent firms to subsidiary units of financial conglomerates. The staggering aggregations of managed assets that resulted from these combinations, often hundreds of billions of dollars under a single roof, surely served the interest of the fund manager. With size came burgeoning fees that helped support the costly battle to build market share and the ability to market the brand name of the fund complex across the nation. On the other hand, conglomeration has hardly served the interest of the fund owner. Giant size and the search for growing profits are unlikely to make the money management process more effective, nor to drive investor costs down, nor to return the industry to its original mission of stewardship and service. Nor has the change improved investor returns. In fact, the reverse is true. The record shows that funds operated under the aegis of financial conglomerates have provided distinctly inferior returns compared to the returns achieved by funds managed by privately held firms. For example, a study prepared using Morningstar data for Fidelity Investments tracked the performance rankings of the funds managed by the industry's 54 largest firms versus their peers over the decade ended in 2003. Its findings were astonishing. All 8 of the top-performing fund groups were privately held, and all 10 of the bottom-performing firms were publicly held. Among the 34 lowest-ranking firms, only 2 were private. 32 were publicly held, including 30 that were owned by conglomerates. It's hard to imagine a clearer confirmation of the theory that public ownership is antithetical to fiduciary duty. Losing our way. The rise of the bottom-line society, the soaring profitability of fund management, and the shift from private ownership of managers to public ownership and then to conglomeration, in all the move of the fund industry from profession to business, have created a new mutual fund industry, one that has surely lost its way. In the industry's hierarchy of values, It is salesmanship, marketing, and the interests of fund managers that now dominate. Stewardship, management, and the interests of fund owners are now subservient. All of these developments have taken place as fund independent directors, although charged by law to protect the interests of fund owners, stood by, seemingly powerless, overwhelmed by an industry structure that puts the fund manager in the driver's seat. Let's consider just 5 manifestations of this massive change in the industry's direction and how they contributed to what went wrong in mutual fund America. 1. The focus on a broad product line of funds, many of them equity funds that assume outsized risk. 2. The driving out of traditional conservative management practices and the driving in of aggressive individual portfolio managers, characterized by a star system. 3. The shrinking time horizons reflected in soaring fund portfolio turnover. 4. The stubborn unwillingness to acknowledge and act on the inherent limitations on the amount of assets that can be effectively managed. 5. The swift creation of new funds on demand and the equally swift burial of the casualties.